The US federal government has racked up a debt to the public as a percent of GDP of almost 100%. And right now, the United States is actually running a fiscal deficit of about 7% of GDP on an annual basis. Almost all serious analysts agree that adding this much deficit every single year to the debt of the United States, which is already very high, is absolutely unsustainable. Now, many of you have probably already heard this line before about the situation being unsustainable. The problem is that hardly anybody ever talks quantitatively about how unsustainable it may or may not be. So in this video, we're actually going to quantify this. We're going to talk about exactly how high the US debt as a percent of GDP can get before the United States gets into some sort of a debt spiral. And we're also going to talk about how much time the US actually has to get its fiscal house in order. In order to understand how sustainable the US debt and deficits are, we need to understand some basic math about how debts and deficits interact. And we need to look at this in relation to the capacity of the US to make interest payments on those debts. So in this section of the video, I'm going to get just a little bit technical, so please bear with me as I explain to you the dynamics that you need to understand in order to evaluate the sustainability of US debt and deficits. So let's start out by defining a few terms. First of all, what is debt? Now, there's a couple of different debt figures that are thrown around when talking about US debt. There's something called the gross debt, and then there's something called debt to the public. Now, debt to the public is the only figure that really matters because this is the debt that the United States is actually paying interest on. There's something called gross debt, which actually includes intergovernmental debt, or debt that the United States owes to itself, that it's debt that one government agency owns to another. But this isn't really relevant for figuring out the ability of the United States to pay off its creditors. And that's what we really care about. And so that's why we focus on the figure called debt to the public. Now, it's crucial to understand the difference between debts and deficits. A debt is an cumulative figure. It's what we call a stock. And the deficit is what we call a float. It's an annual figure. It's the amount that is added each year to the debt. And we also measure that as a percent of GDP. So for example, when the United States federal government spends more money than it actually takes in revenue, that is a deficit. And we measure that deficit relative to the size of the economy. And that deficit, in order to finance it, in other words, that excess of expenditure relative to revenue, it has to be financed with debt. And so that adds to that national debt that we just talked about, that we also relate in terms of GDP. Now, why is it really important to talk about debt and deficits as a percent of GDP? It's very important to understand this because in the media and politicians are always talking about the debt being 30 some odd trillion dollars, or that the deficit is $2 trillion, or that the deficits in the next 10 years are going to be $7 trillion. Those numbers are so astronomical that they're almost meaningless. It's hard to even get your head around what those sort of numbers mean in terms of dollars. What we really need to think about is how much these debts and deficits are in relation to the ability of the United States federal government to actually pay those debts. And so we measure those debts and deficits relative to GDP. Why? Because GDP is the total amount of goods and services that are produced in the US economy. And the government taxes all businesses, taxes all production. Everything that is produced in the United States is taxed. And so GDP is sort of the taxable base. So that this taxable base, which is GDP, sort of measures the capacity of the country to actually pay back these debts. So the idea is when the debt gets too high in relation to the country's production and its income from that production, then the country's going to be in trouble. And what we're going to be looking at in this video is how high can that debt get in relation to the country's production and income before the country really gets in trouble. Now, I have an article that I published on Seeking Alpha that I'm going to show you right here, where I go through in great detail exactly how it is that you need to think about the ability of the United States to actually pay off its debt. There's actually some very clear mathematics there. It's not complicated mathematics. It's something that anybody can actually learn if you just take the time to look at it a little bit. So I really encourage you to take a look at this article, because the things that I explain in that article are things that you probably haven't seen anywhere else, and you're probably not going to see it anywhere else. Now, there's a lot of things in that article that I'm not going to actually go into in this particular video, but I do want you to focus on one very important thing that I bring up in that article, which is the distinction between the overall fiscal deficit and what's called the primary fiscal deficit. Very important to understand the distinction here. The overall fiscal deficit simply means it's the overall shortfall that we have when we take the total amount of revenue that the government has and we subtract the total expenses that we get, including interest costs, because interest costs are a very, very big part of the overall government expenditure. But the primary deficit excludes the interest payments. And so when we're talking about the primary deficits, we're just talking about regular expenses excluding interest costs and comparing that to the revenue. Now, this is very important because in this article, one of the key insights that I explain is that the United States or any government can actually stabilize the growth of a debt as a percent of GDP simply by stabilizing the primary deficit. In other words, if you can bring the primary deficit down to zero, achieve a balance in the fiscal accounts, then your debt as a percent of GDP will actually stop growing. And I actually explained the math of how that works there. Now, a key assumption there is that the rate of GDP growth is going to be roughly equal to the real interest rate on that debt. Now, that's a pretty reasonable assumption. In the case of the United States, roughly speaking, GDP growth in the United States is something along the order of about 2% per year. That's real GDP growth. And that's the projection towards the future. Sometimes that projection might be a little lower, a little higher, but somewhere in the neighborhood of 2%. Now, real interest rates, which is the nominal interest rate minus inflation, is also roughly around this neighborhood of 2%. Now, as long as this relationship holds true, then all the United States actually has to do to stabilize its debt as a percent of GDP is to run a zero balance in its primary fiscal balance. So let's quantify this. Overall, the United States is running a fiscal deficit as a percent of GDP of around 7%. But its primary fiscal deficit, in other words, the fiscal deficit, not including interest payments, is only about 3.3% right now. So by virtue of the principle that I just explained to you, if the United States can simply lower its fiscal deficit by 3.3% of GDP, it can actually stabilize its level of debt to GDP. By stabilizing, I mean it can keep it from continuing to grow any higher. Now, this is important because the United States, contrary to popular belief, doesn't need to actually start paying down its debt as a percent of GDP. The United States can continue to indefinitely have a level of debt that it currently has, just as long as it's able to make its interest payments. That's all that the United States really has to do. But it can't continue to have that debt, the principal on the debt, continue to grow. So the real question is, how can the United States prevent the principal on its debt continuing to grow as a percent of GDP? And as I just mentioned, the only thing it actually has to do is do an overall adjustment to its fiscal accounts of about 3.3% of GDP. This is actually pretty doable. Now, in my article on Seeking Alpha, I give an example of how this can be done. And one of the things I show there is that it's really not going to be possible to cut the deficit by this 3.3% by only cutting spending. And it's not really going to be possible, at least politically possible, to do this by only raising taxes. It's going to have to be some combination of both. And here's why. On the expenditure side, only 27% of all expenditures are actually discretionary expenditures. The rest of them are Social Security and Medicare, which are expenditures that are extremely hard to be able to cut. These are entitlements that, politically speaking, are almost untouchable, and it's going to be very difficult to really cut much of the budget from entitlements. So when we're cutting the budget, we're going to be cutting it from discretionary spending, and that's actually a relatively small slice of the budget. talking about non-defense discretionary spending, because we know that during the Trump administration, we're not going to be cutting defense spending very much at all. So that really just leaves about 27% of the budget that we're going to have to be cutting expenditure from. Since discretionary spending is a relatively small part of the budget, there's only so much discretionary spending that you can actually cut. So some of this is going to actually have to come through raising revenue, in other words, through raising taxes. But what I point out there is that if we actually evenly split up the fiscal adjustment, what we're talking about here is a 1.65% of GDP adjustment on the revenue side and on the cost side, and that's actually quite reasonable. Overall, what we're talking about is about a spending cut of something like 8% of total spending would have to be cut, not as a percent of GDP, but just the overall amount of spending, cut it by roughly 8%. And then on the revenue side, we need an increase in revenues of about 9.65%. Again, not of GDP, but just an overall raise in 9.65%. Now, if you look at either of those figures, either decreasing spending by 8% or increasing revenues by 9.65%, that might be very difficult to achieve in 1 year, but it doesn't have to be achieved in just 1 year. That can be spread out over a 3 to 5 year period. And if you do that, you won't even feel it. One of the benefits of doing this over a gradual period of time is that if markets believe that the United States is actually getting its fiscal house in order, what will happen is that interest rates will actually decline, and that'll actually help boost GDP growth. So a lot of people fear that in order to get the US fiscal house in order, we're going to have to do some really drastic things that could cause a business cycle recession. That's not actually true. If it's done gradually and if it's done right, this can be done in a way that won't cause a business cycle recession, and to the contrary, it could actually spur economic growth by lowering interest rates. And this is not just pure speculation. This is something that happened a few years ago during the Clinton administration where they managed to actually drastically cut the debt as a percent of GDP. And that caused interest rates to really drop drastically, and that actually helped to boost GDP growth. So I want to be clear here. It's not that I'm saying that it's going to be easy to do this, and I'm not even predicting that this is going to happen, and I'm not predicting it's not going to happen. But it's very important to understand is that there's a lot of people that exaggerate out there and say that the situation is already hopeless, that there's absolutely no way that the debt is so high that the United States is inevitably going to have to either default on its debt or rely on inflation to inflate its way out of the debt. You hear this a lot from people, for example, that talk about Bitcoin, or sometimes people that talk about gold, that the only thing you should do is invest in gold or Bitcoin because the US debt is so crazy high that there's no way that it's ever going to be able to pay that debt, and that the only way out of the debt is going to be inflation. And you hear this story over and over. It's just not true. And so by quantifying these numbers, I'm showing that this is actually something that's doable. But by showing these numbers, I'm also showing that this isn't for free. In other words, getting the US to get its fiscal house in order isn't going to come for free. There's going to have to be some sacrifices that are going to be made. There's going to be some tough political choices that are going to have to be made. And you might be skeptical that they're going to get done or not, but it's not an impossible task. So we don't need to either get too pessimistic about the speculation that the US is already too far gone and there's nothing can be done, but we also can't just ignore this problem and say, hey, it's no big deal. Because the reality is that if we continue to pile on more and more debt by running deficits year after year, this is going to have a disastrous impact on the economy eventually. Now, how much time does the United States actually have to get its house in order? That's the subject of my next video, because we can also quantify that. We can quantify by how high the debt can actually go before the United States is actually in really big trouble. And we can quantify how long the United States might have to actually get its fiscal house in order. So we're going to address that. But in this video, I just really wanted to focus on what it would take for the United States to get its fiscal house in order, whether it be now or whether it be in a few years. That's the important thing, is to understand that it's possible, but hey, it's not going to be that easy either. The other message that I want you to get out of this video is that because the US debt as a percent of GDP is already so high and the deficit is so high, and this situation seems like it's sort of spiraling out of control a bit, this is already getting felt in the markets. In other words, this is having a real impact. US real interest rates have been rising highs that haven't been seen in 17 years. There's something called credit default spreads, CDS, that have risen to levels that imply that US debt, for example, is several notches below the official ratings that are actually on US debt. The US dollar has actually come down significantly relative to other currencies because people around the world are worried that the United States might eventually have to inflate its way out of its debt. So there's very, very real signs that people are concerned about the situation. It's actually having an effect on the market. And this is something that I'm taking into account in my portfolios. It's very important because there's nothing more important in the world that's going on right now than this US fiscal situation. The US Treasury market is the base layer of the entire US financial system. And therefore, it's the base layer of the financial system of the entire world. In other words, if the US doesn't get its fiscal house in order, the very foundation of the US financial system and of the international system will blow up. It's very, very important. And so this is a problem that's not going to be going away. This is not just news that you're going to be hearing about in the next few weeks and it's going to go. We're going to be hearing about this for years because it's something that threatens the very foundation of the financial system. And in your portfolios, you really need to know how to invest in this different environment because this has truly not been a problem in the past. In the past, people have talked about debts and deficits, but it didn't actually matter until now because the debt hasn't been as high as it is right now, nor the deficit has never been as high as it is right now as a percent of GDP. So I have two different portfolios where I'm doing things in two very different ways. I have an aggressive portfolio that's called the crisis opportunity portfolio, where I try to take advantage of some of the volatility that's caused by these dislocations in markets that are caused by things like the fact that people are worried about the United States' very high levels of debt and deficits. And then I have a much more conservative portfolio that I run on the Seeking Alpha marketplace called Successful Portfolio Strategy. And this is a portfolio that is good for any investor. It's a much more conservatively run portfolio. And we also have investments that are specifically tailored to be able to handle this situation right now and in the future. In the past, you didn't need to pay attention to any of this because it wasn't a big deal. But it's a big deal now, and it's going to continue to be a big deal in the future. And there's certain things that you need to be doing in your portfolio in order to account for this. And it's not buying a lot of Bitcoin, and it's not buying a lot of gold. Those are not the sort of things that we're doing in the portfolio. Now, there's a place in the portfolio for gold and a time to buy gold, and there might even be a place for Bitcoin. But I just want to be clear that that's not really the foundation of how a serious portfolio is run. So I invite you to join me for my next video where I actually talk again quantitatively about how high the US debt as a percent of GDP can go before we really start to get problems and how long it's going to take for us to get there. So until next time, thank you for joining me.